What's going on, everybody? Michael Silva here. Well, the S&P 500 today closed at a new high. It didn't reach a new all-time high, but it closed at a new all-time high. While everyone's focused in over here on the short basket names, holy moly, GameStop, AMC. We talked a lot about those short squeezes. Yesterday's video on the Stock Market Brief show. Today, we're going to talk about the winning streak that we're on and what happened after the last time it happened, what happened after, and how we can capitalize on the situation and or protect ourselves in turbulent times. All that and more on today's Stock Market Brief show, where we navigate the financial markets through the lens of technical and intra-market analysis. If you haven't done so already, can you hit that thumbs up? It'd be greatly appreciated. It's how you sponsor today's episode. And also, you can look at the pinned comment, take a look at the swing trading community, which is only $9 a month, offers all kinds of benefits over there on the Discord. That's where I post everything. But you sign up through Patreon and take a look at our partners, Interactive Brokers. They are the she. Let's get into today's episode. All right, everybody, welcome back. So today, right, we're going to do a quick snapshot of what happened today. We had the PPI data, the core PPI data, came in hotter than expected, and the markets, well, 10-year yield took off to the upside, but then it reverted all the way down. The markets, ES, we'll take a look at ES, negatively reacted when the report came, but all of a sudden things changed. Now, that could be because things were revised lower in the March report, or it could be because we're just going into the inflation data that's right around the corner. And as we're moving into these inflation data numbers, the implied volatility in the markets is obviously growing. So what does that mean? It means that our daily expected moves are getting larger. So I share this with the daily swing trading community every day. I'm going to share it once again here because I find it to be important in these turbulent times. So the S&P 500, the SPX, is looking at a plus or minus $43 expected move. These are the levels if you want to put them on your screen. On the last video, I shared this, and if you're paying close attention, well, we came right up into the upper daily expected move for SPY before backing off. And I also included the 2 sigma levels because every once in a while things get a little spicy. Yes, so we closed at an all-time high here, and this right now is 9 consecutive days to the upside. That's 1, that's 2, that's 3, that's 4, that's 5, that's 6, that's 7, that's 9. 9 consecutive days to the upside, okay? And I was like, man, when's the last time we've had 9 consecutive days or more? And so I went ahead and downloaded my data set, plugged it into ChatGPT, had an argument with it back and forth, and came out with these time frames. You can see we had 9 consecutive days here, and the last time that we had a consecutive winning streak like this was actually in 2010, February to March. And that was 14 consecutive days. Prior to that, you had November 2024, so 14 years. That's crazy. And then 1995. Now, I haven't checked these times for the validity of them, but I did check this one because that was the last time, and it was accurate. Okay, so if we go back to 2010, what did it look like? What did the chart look like on that 14-day win streak? Well, it was up right here, up right there, and so forth, 14 days. This day was one of the down days. And what I found so uncanny about this situation was just how eerily similar these things looked together, right? They almost like deja vu. We had this turbulent time in 2010, right before that big win streak. We went up for 14 days. Even when we started to move from the low, we consolidated and then had the win streak, right? We moved from the low, consolidated, and then had the win streak. And even prior to that, which is roughly around the same time frame, this is in early 2010, and we're kind of trading in the midway point of 2024. I thought that to be just very interesting. Now, analogs have no predictive power. However, when we look at what happened after, if we were to go through the same type of turbulence, we then have an idea of how we can protect ourselves in these times, which we discuss about very frequently in this show. So what happened in 2010, shortly thereafter, we started breaking this prior swing high. Well, what happened shortly after was we went higher. We went higher and higher and pressed. We didn't have that. We didn't go past the 14-day win streak. But then all of a sudden, we started seeing very, very, very turbulent times in the market. And mind you, it was a different macro environment. I know. I can hear the little trolls in there. Oh, technically, that's when it was. Shut up. That's what I have to say to you. So yes, very turbulent time and cut the low. So how do you protect yourselves if we're about to run into a period of time where we get a lot more volatility like that? Well, there's one thing that I like to look at specifically is the flip line. Now, the gamma flip line tells us the way that dealers are going to act. In short, I guess, right? The unprofessional way to say what this line is. And when you're above the gamma flip line, and this changes all the time, dealers look to buy the dip and sell the rip, buy the dip and sell the rip. Okay, when you're above it, that's what happens. That's when liquidity is actually added and volatility typically is reduced. So one thing you could look at here is like, well, okay, well, we have our call wall. This is the big level up here at 5,300. That's where traders are reaching up for right now. Okay, and we came into 5,250, which was another important level. We jammed right into that. And 5,200. It's these three levels that are incredibly important to the S&P 500 in this given moment of time. Now, if we start breaking under the gamma flip line at some point, whether that moves up throughout time and it's higher, but when we get below it, what do dealers do? Well, they sell into selling. They buy into buying. Liquidity dries up. Volatility increases. And that's when you get wild and crazy price swings like you see over here. Okay, it doesn't have to be to this extent by any nature, but I can go back to right here and tell you this period of time, guess what? We were in a negative gamma environment. And over here, as volatility has been reducing or going down, volatility decreasing, however, liquidity increasing, we get these small little buy the dip types of moves up to the upside. Ooh-wee. So how do we protect ourselves in these times other than just the gamma flip line? Well, take a look here. So this is when we broke the high and we started moving higher in 2010, and then we started to see the volatility really increase. Now, where do you see volatility really start to get crazy? You start to see it under this purple line, right? Under this purple line when it is declining. See, when it's inclining over here, it's actually pretty steady moving up. It's when the 5-day moving average, which is what that is, starts declining, we start to see a lot more volatility. So one would say, hey, if the 5-day moving average is declining and you're below a gamma flip line, you might want to proceed with caution. Now, where's the 5-day moving average right now on a smaller time frame chart, the 15-minute chart? It is inclining and price is currently above it. You want to take it a step further? Let's take a look at weekly expected moves. The lower weekly expected move is at 514. The upper weekly expected move is at 527. And tomorrow, we talked about the daily expected moves. What's the market pricing in as far as volatility? Well, you see the upper level, the upper daily expected move is right in line with the weekly expected move. And it's very common to tag one of these levels. So when the report comes out, I would not be shocked to see the market move towards one of these levels. You just got to be cautious. You got to be careful. This is a binary event. I let the market digest, and then we move from there. I'm going to step into one more strategy that you can use while the time comes when the CPI report comes. You can use an anchored volume weighted average price. And when the report comes, you can anchor the VWAP, the TWAP, the anchored volume weighted average price, the time weighted average price, whatever you want to call it, to that time, that period, and then watch to see how price reacts and responds around it. If it's above it and it starts moving up, that could be a positive sign to look to buy the dips. But just be cautious because obviously there's many things pointing us in the direction, including today's hot expected PPI, that inflation could be hotter. Market's been ripping. There's all kinds of different various signs that we can look back in hindsight and be like, I knew that this bad stuff was going to happen. But as it stands now, in this current moment, we're above a rising 5-day moving average. We're above the gamma flip line. All signs are green, okay? But we're a little extended, right? We're a little extended, a little frothy, but all signs are green. So watch for consolidations, watch for digestions, be tactical when you approach these markets. And that's all I got for you on today's episode, everybody. See you later.